Hi everyone, I'm Fletcher. Today I'm gonna present one of our clients' personal financial statements and analysis. So I'd like to introduce our group first. We have 5 members in our group, and all of us are studying accounting and finance at Churchwell College. So you can see this is our outline about what we're gonna present today. Starting off with our client's background, and then we're gonna give you some of his personal financial statements and based on those, we're going to give evaluation, analysis, as well as a recommendation. So let's get started with our client's background. Gary Fletcher, he was a student of Churchwell College and he's graduated about 4 years ago. The problem is that he decided to buy a condo 2 years ago and now he's finding his money tight even though he's working very hard at his job. So that is the reason why he came to our group and asked for a professional perspective to manage his finance in a better way.
Hi, I'm Hong Min. I'm going to present Mr. Fletcher's net worth statement and its assessment. Let's see his net worth statement. As you see, his total asset is 424,000, including 6,000 liquid asset. Total liability is $246,000. So net worth is surplus $129,000. Let's move to the net worth assessment. From the net worth statement, we can assess Mr. Fletcher's purchase power and estimate net worth growth. Even though he has a positive net worth, it is not strong enough to keep purchase power because liquid asset and working capital is too lower than recommended rates 1. And considering his life stage, early earning, he should balance saving and debt. In doing so, he can make positive net worth growth, but he seems to have excessive loans for his income. Overall, it is necessary to strengthen his liquid asset to keep purchase power and generate net worth growth.
Hi, my name is Jia Bui. To continue our presentation, firstly, I will talk and evaluate about the cash statement and how to improve based on the result. The cash flow is calculated by subtract the total expense from net income. It can be seen that the cash flow is negative $13,350 is deficit. It means that Fletcher had to spend money to pay for expenses exceed the money he got from the income. This is because of the overspending in expenses. So he needs to plan for the expenditure by minimize variable expense such as utility, transportation, vacation, parking expenses. For example, instead of moving by car, he could get public transportation to reduce car insurance and parking fee. Secondly, I will present the meaning of emergency fund ratio. It's determined by dividing the liquid assets by monthly expenditures. Financial planners generally suggest have 3 to 6 months of necessary expenses set for the emergency fund. The ratio indicates that Fletcher has 1.2 months of coverage. Fletcher should spend less and save more to increase his savings for emergency funds up to or more than 3 months. This is the way how to increase the emergency funds ratio in his case.
Okay, my name is Trần Nguyễn Ngọc Hân and I will handle saving ratio and debt ratio. In saving ratio, I will go back to cash flow statement to see if it's surplus or deficit, and I can see that it's deficit. So I will take deficit plus regular annual saving, and all of that will divide gross annual income. And when public deficits spending increases, as individuals spend less and save more to prepare for increased future taxes to finance the deficit. So I don't think it's good if continue increasing like this. Since the recommend ratio is about 10%, he should maintain his saving ratio. And move to the next debt ratio is give a percentage of assets that are financed by borrowing, and this is the only one do not have industry standard or recommendation. And because Gary just graduated from GVC 4 years ago and he just has a condo, so he has more expenditure, so that total liabilities increases. And like him, younger clients typically have higher percentage than older. So I will move to the next one.
As you know, I present total debt service ratio and recommendation for Mr. Fletcher. According to the formula, Mr. Fletcher has 38% of TDSR, and by the 38%, his repayment capability is still healthy. Since TDSR not exceed 40%, it is being managed responsibly. Lender will know he can make payments and getting approved for a mortgage. There's two ratio evidence that Fletcher should reduce his spending. Firstly, debt ratio. He has 0.7 debt ratio and 1.2 emergency fund ratio. So, through the two ratios, he owes too much for his property, and if there is an emergency, his cash mobilization is not high. Then what Fletcher should do? Savings? He has 19%, which is higher than average, and spendings? In his cash flow statement, clothing, entertainment, and vacation remain except for liability-related and required expenses for living. The key point of recommendation is on his discretionary expenses. If we reduce Fletcher's discretionary expenses by 50%, Fletcher could save an amount of $62.50 for his budget. This amount can't thoroughly improve Fletcher's financial conditions, but decreasing discretionary expenses can be an immediate way to work. And this is our references. Thank you for listening our presentation. Thank you guys.